Welcome back to The Calling. I'm your host, Connor Coman, and today we're going to continue in the lane of financial literacy that we started in last week. I highly recommend that you go back and watch our video on the must-knows of money because that's going to give you more context and understanding for what we cover in today's episode. We're going to take it a step further today, and I'm going to give you a blueprint for creating your own personal financial plan or financial strategy. So here are 6 points with some action steps for a solid financial foundation. Point number 1 is cash flow. The start of all of this is you have to have money coming in, whether that be from your job or maybe a business you have, real estate, investments, social security. The point is you have to have a source or multiple sources of income that bring in money to you. The action step for this point is to balance your income versus your expenses. Many people call this the budgeting process. So the first thing you need to do is write down how much money you bring in every month. What is your income? What is your monthly take home on average? Next, you got to write down all your monthly expenses. The car, the insurance, the groceries, food. And then you're going to add up all of your monthly expenses to find the total amount of money that is coming out of your pocket every month. Now, once you've balanced your income versus your expenses, you want to make sure that you're bringing in more money than you're spending. Sadly, many people are in an opposite situation where they're actually spending more than they're making. This is what's called a deficit. And you know that you're in a deficit if you're just draining your savings accounts, living in debt, living off of credit. And if you are in the deficit, what you want to do, you really have two options. You can either make more money or you're going to have to start limiting your living expenses. But whichever one you do, the goal at the end of the day, again, is to be making more, to be bringing in more than you're spending. If you're in that situation, you're going to have more money at the end of the month to work with. This is called discretionary income. Point number 2 is emergency fund. Listen to this. 57% of Americans would not be able to afford a $1,000 emergency. So the action step for this point is to start building an emergency fund. You want to have an account saved up, not for if, but for when things happen. When the car breaks down, when the kids have a medical bill, when appliances break down, family needs money. Life happens, things are going to happen, and you want to have a designated account to tap into for these situations. Now, personally, I believe this emergency fund should have 3 to 6 months worth of your expenses with an ultimate goal of having a year's worth of expenses in this account. For example, if in step 1, the balancing of the cash flow, the income versus expenses, you found that your bills are $2,000 every month. $2,000 goes out every month. You want to have 3 to 6 months worth of that. So $6,000 to $12,000 in this emergency fund with an ultimate goal of having $24,000 so that you have a year's worth of these expenses saved. Now, this is important. This emergency fund is separate from your checking account. This is not money that you're spending and tapping into every day. This is more of your peace of mind account. Imagine the peace of mind knowing that you can not work, something comes up, and you have to take off for a year. It's completely fine. You've saved up that amount of expenses and you're completely covered for an entire year. Most people, unfortunately, do not have an emergency fund. They do not have this savings habit. So where do you think they go when things come up in their life? That's right. They swipe plastic and go deeper and deeper into credit card debt. So it would be very wise to start building this savings habit and getting yourself prepared for whatever may come your way. Point number 3 is manage debt. Let me start with this. There is such thing as good debt and there's such thing as bad debt. With good debt, yes, you can get into debt and use that to leverage it to buy assets. People do this in real estate a lot. However, that's not what I'm talking about here. We're talking about bad debt in this conversation. The drowning in credit card type of debt. Now, this type of debt is very easy to get into and hard to get out of. And that's because of the interest rates that are on these credit cards. So over time, the balance that you owe on this card just continues and continues to rise. And what are we told? Many of us were told growing up, take out a credit card so that you can build credit. However, that came with no education on how to properly use that, how credit cards work, and how to do it the right way. So what do we see today? We see an absolute debt crisis, credit card crisis. We see over $1 trillion, a 20-year high in credit debt in America today. We see an average cardholder in America in over $6,500 worth of credit card debt. So the question is, if you are in this type of debt, is there a plan in place where you're actively paying off this debt? I want to give you a few quick strategies on how you can start paying this debt off faster. The first strategy is called the snowball. With this strategy, you're prioritizing the balances that you owe. So what you start with is the lowest balance. You're going to pay off the smallest debt that you owe. That's going to give you motivation to move on to the next one, and then ultimately pay off the highest balance that you owe. The next strategy is called the debt avalanche. With this one, you're prioritizing the interest rates. So you're going to attack first the balance that has the highest interest rate attached to it. Once you pay that balance off, then you move on to the next highest interest rate. And you keep going about it this way. And the point of this strategy is over time, you end up paying the least amount in interest over time. And a third strategy for debt management is what's called consolidation. If you're in an amount of debt that is just not manageable, spread across a bunch of credit cards, and you'll never be able to actively pay your way out of this debt, companies will actually come in, buy up all your debt, and get it all into one account where you can pay this off faster. This is called consolidation. The only downside to this is it could drastically affect your credit score for a time. So I would not recommend going into consolidation if you're looking to make a major purchase anytime soon. Point number 4 is proper protection. Let me ask you a question. What is your number one asset? You may think, well, it's my car, it's my home, my job, my investments, my property. It's actually you. You are your number one investment. Why? Because you're the one who produces income. You're the one who has the power and the ability to go acquire these other assets. Without you, you wouldn't have any of these things. So you are your number one asset. Let me ask it to you with this question. If you had a money printing machine in your home that printed money for you, would you get insurance on that machine in case anything went wrong with it? Of course you would. Well, guess what? You are that money printing machine. It's crazy to me. We get insurance on our phones, our laptops, our cars, just about everything. And yet many people do not have any insurance, any coverage on their own lives. I'm a believer that everybody should have at least some form of life insurance protection, especially if there's children in the picture, or if you want to have children and start a family in the future. As a parent or a future parent, would you agree that is your job, to provide for your family and your children? And now what exactly you should have in place, the type of policy, the amount of coverage, that is all going to be based on your own personal needs and objectives. Here's a couple more reasons why you should consider having life insurance as part of your financial foundation. Not because of what happens if you die, but because of how you can use it while you're alive. Many life insurance policies nowadays come with what's called living benefits, where if you come down with cancer, heart attack, stroke, and you need help paying for medical bills, you can tap into the death benefit and use it while you're alive to help you with those medical expenses. And here's another reason. Depending on your situation, you can use life insurance as a wealth building tool, where part of your premiums that you're paying into your insurance actually go into an account where the money's being invested and grown and can be accessed completely tax-free. This is why banks have tens of billions of our dollars in life insurance products. You may hear the term going around nowadays on social media called be your own bank. This concept, this strategy is done through cash value life insurance. Here's the point. Most people get life insurance for when they die, but the financially educated get life insurance for while they're alive. Why is this? Again, because you can use this insurance as a wealth building tool. And if you're not going to use it for that, why not at least get your medical expenses protected through those living benefits and your family protected through that death benefit? Point number 5, build wealth. When it comes to investing and growing and compounding your money, it all comes down to the 3 wealth building concepts. This is why you have to go watch our video on the must-knows of money, because we dive deep into the explanation of how to outpace inflation, to minimize taxation, and to manage risk and protect yourself from those market downturns. Now, where can you put your money for it to do that for you and build wealth? Plenty of places. There's stocks, bonds, mutual funds, ETFs, CDs, precious metals, digital assets, real estate. You can do this through retirement accounts like 401ks, IRAs, 403bs, TSPs. There's Roth accounts, cash value life insurance. These strategies and solutions to build wealth for you are absolutely out there. And what's best for you is all dependent upon your personal situation, your goals, your needs and objectives, your risk tolerance. There's no one size fits all when it comes to investing and building wealth. It's all dependent upon where you are at and what you are able to do. So what you need to do for this is either get to researching and learning what these accounts are, how they work, Or you can sit with a financial professional that you trust who can guide you and teach you on what a wise investment is for your situation. And step number 6 is to preserve your wealth. Listen, if you follow steps 1 through 5, you will have wealth, or what many call a nest egg. But the goal from that point moving forward is to now protect and preserve what you've grown and accumulated, and then to effectively transfer it to the next generation. Now, there's great strategies on how you can protect and preserve your wealth and then have a smooth transition of this wealth to the next generation. There's strategies that can help you avoid taxation. Remember, it's not how much money you make, it's how much money you keep after taxes. There's also strategies that can help you avoid things like probate court. Having your assets in what's called a living trust is a great idea in my opinion, because that can assure you that your assets will go straight to your beneficiaries. Without the protection of this living trust, your assets may be subject to probate court, where they'll sit in the control of the government for anywhere from 4 months to 2 years, and Uncle Sam can come in and pick at it before your beneficiaries ultimately see what you've grown and accumulated for them. So there you have it, 6 points with your action steps for a solid financial foundation. But before you go to work on implementing these points, ask yourself this question and start here. What is it that you want? What are your goals? What do you want? Do you want to buy a house? Is it to buy a car? Is your goal to send your kids to a certain school, to retire your parents, to get out of debt? What is it for you? Clearly define this vision for yourself of what you want financially, and then go to work on implementing these steps. Here's what I believe, that whatever your financial desires are, you can have them. I do not believe that you are here on this earth to struggle, to pay bills, to live in survival mode, ultimately to die. I believe that if you follow these steps that we covered today, that this will set you on a good path. And if done correctly and properly and diligently, this will result in financial abundance, financial peace, and ultimately a financial legacy. We'll see you next time on The Calling.